So so if we read the scenario on top again, it just says that, so Plastic, a company that manufactures plastic products, is listed on the Johannesburg Stock Exchange. You are assisting the company with finalization of the financial statements for the year ended 30th June 2018. The following information is made available to you. So in that paragraph over there, the most important aspect is we're dealing with the year ended 30th June 2018. So I'm going to go straight to point number 2, because point number 1 relates to leases. So there's an employee benefit expense. The following information relates to Plastics employee benefit expense. So we have 2 divisions: homeware division, industrial plastic division. So we have number of employees, 25 and 10, monthly gross salary expense in total, 297,500 and 115,000. Monthly defined contribution plan, payment in total, 90,000 and 36,000. They're telling you 50% is the employee and 50% is the employer. Leave day balance on 30th June 2018, 75 days and 30 days. They say you may assume that all employees receive the same remuneration and that there are 260 working days in a year. Salaries are paid on the last day of each month. Plastic pays the monthly pay-as-you-earn taxation amounting to 2,070 Rand per employee to the South African Revenue Services on the last day, on the 7th day of the following month. The company awards 20 days leave per calendar year to each employee. So just take note, there's a calendar year, which is forfeited if it has not been taken by the end of June the following calendar year. Experience has indicated that no leave is forfeited. The company do, however, pay out any accumulated leave when an employee's employment ends. The Plastic does not expect any voluntary resignations in the 2019 financial year. The leave pay accrual account for the homeware division was increased with 49,000 in the financial year ended 30th June 2018. Okay, so in that paragraph, it's only short-term benefits over there. There is salaries, there is your defined contribution, there is leave. Okay, so those are the 3 things happening over there: salaries, leave, and defined contribution. Those are all short-term employee benefits. Now, what's important to take note is to understand how the leave works. So remember, our financial year is 1 July to 30th June. They give an employee 20 days per calendar year, not per financial year. So you get 20 days per calendar year. And what they are saying, at the end of the next financial year, June, all your leave needs to be taken. If the leave is not taken, it gets forfeited. But like they're saying, based on experience, no leave is ever forfeited. Okay, so that's important to take note. So that means there's no adjustments we need to make to leave days. So they say restructuring, closing of industrial plastic division. So restructuring falls under IAS 37, provisions, contingent liabilities. Okay, so just remember, restructuring, there's a section in IAS 37 that deals with restructuring. But there is an aspect of restructuring that is playing a role in our scenario. So they say after numerous failed efforts to sustain its business activities in the industrial plastic division, Plastic decided on 1 June 2018 to close the industrial plastic division. So in the current financial year, they've made the decision to shut down. On 20th June 2018, Plastic paid its legal advisors 25,000 Rand to draw up letters individually addressed to each of the 10 affected employees, which contained the terms of the employee termination plan. Each affected employee will receive the letter on 30th June 2018 when the restructuring plan will be communicated to them. when we come to I-37, there are certain rules that apply with regard to restructuring and what you can recognize as an expense and so forth. Okay, so in this case, the restructuring conditions are met because remember our financial year end is 30th June 2018. Before 30th June 2018, on 28th June 2018, the company has communicated it to the people being affected. So that means the restructuring conditions are met. There's a few conditions that need to be met. So we will be able to recognize any liability and any expense relating to restructuring. So they say, according to the terms of the plan, each employee will receive a 30,000 Rand lump sum payment on 30th July 2018, in addition to their monthly salary, should they elect to terminate their employment on this date. Okay, so if they elect to terminate the employment on 30th July 2018, they will receive a 30,000 Rand lump sum payment. Now remember, you will only get that lump sum payment as a result of electing to terminate your contract. So what does that mean? You will, that is a termination benefit. So if you elect to terminate on 30th July 2018, so if you decide that your last day will be 30th July 2018, each employee will receive 30,000 Rand, okay? In addition to their monthly salary, okay, employees may also elect to remain in the service another month to assist with the closure of the division, and will then receive an additional month's salary, including all benefits. Okay, so remember, whether you decide to terminate on 30th of July or stay another month, meaning up until 31 August, then you will get the 30,000 Rand, but you'll also get an additional salary. Okay, so just keep in mind that additional salary is just a normal salary because you are working for them. Plastic expects that all employees will continue their employment until 31 August 2018. On 31 July 2018, the company will also contribute 80,000 in total towards these employees' defined contribution, in addition to their monthly contribution. Affected employees may not take any leave for the period 1 July 2018 to 31 August 2018. Okay, so they're not allowed to take any leave. So let's have a look. So additional information. Plastic classifies its expense by function and has an incremental borrowing rate of 8% per annum. So that incremental borrowing rate, that is just basically for leases. Right of use assets are measured according to the cost model and depreciated on a straight line method. You may assume that the normal income tax rate is 28%. All amounts are material. So required, we're going to deal with required B. So they say provide journal entries to account for the employee benefit expense of the industrial plastic division in the financial records of plastic for the year ended 30th June 2018. Narrations are not required. Okay, so we're going to deal with part B. So here you can see in part C, they're telling you, prepare the profit before tax note to the financial statements of Plastic Ltd for the year ended 30th June 2018 with regards to the information supplied. So we need to do part 1 and part 2. So we're already doing part 2, but part 1, we have to deal with that. So remember, the only thing we're not doing for part 2 is the homeware division. We're only focusing on plastic division. So just take note, this part B is only asking us for plastic division and not for both divisions. But when we do part C, we're going to have to bring in the homeware division as well as the leases. So this part C question like I think it's 100%. I think it comes in every exam. Okay, so every test 4. So just make sure, well, we can test it, but as far as I can see, almost every question I've covered with regarding test 4 have this question. Whether it's 17 marks is a different story, but this question is basically almost always there. Okay, so it's an important question, but we're not going to deal with it now. We're going to deal with part B. I'm just quickly going to go to Google to open up the just to open up the drive. Okay, so what I'm going to do, so this here is employee benefits. Okay, so now we're going to do the journal entries. So all the journal entries will happen at 30th June 2018. Remember, we have 4 categories: termination, short-term, other, and post-employment. There's no post-employment, which is no things relating to costs incurred for an employee after their time, after the employment have come to an end. So there's no post-employment. There's no other, but there are short-term benefits, and there are short-term benefits, and there are, what's the other one? Termination benefits. So I'll just go in the order that they give it. So if we go to the scenario again, so if we go to the scenario again, so remember, provide journal entries to account for the employee benefit expense of the industrial plastic division for 30th June 2018. Okay, so just take note of that. Only the industrial situation. So for 30th June 2018, very important, 30th June 2018. So what do we know? So for the year 30th June 2018, they had monthly gross salary of 115,000 Rand per employee. Well, I'm assuming it's per employee. So if we work that out, so remember it will be as follows. So remember we have the following expense, right? What happens? I just want to see if there's something. So the monthly, we have a monthly expense that gets paid at the end of each month. So the way we're going to work this out is as follows. So what we know, there's going to be a debit and a credit So what we will do, an employee's salary, we will just say employee benefits. Employee benefits. You can call it short-term benefits, or you can just say salaries. Now remember, an employee earns a salary. So in June, on 30th June 2018, the company will recognize an expense for the full salary. For every debit, there must be a credit. The credit, they're telling you that they pay the salary at the end of the month. But now remember, when the company makes payment to the employee, the amount that they pay the employee is net of tax. So it's very important to take note. The payment made to the employee is not equal to the gross salary, because remember, there are some deductions that have to go off. So what gets taken off in this case is only pay as you earn. So the amount that gets paid is the amount that the employee will receive in their bank account. So just take note. You can think, but just make sure you think of this logically. So if we have working one, once again, you can do the calculation much quicker. I'm just doing it a little bit longer, just so that when you work through it again, if you do work through it again, you actually can make sense of the workings. Okay. Remember, in an exam, you can write everything in one line. There's no need to do all of this detail, how structured I have it. But the reason why I do it structured, because I'm not writing an exam. I'm doing it so you can make sense of it. So my solution is generally longer than what you would need to set out in an exam. Okay. But if you use Excel, it's probably easier even using the structure. So remember, we're trying to work out the salary expense. So we can just say gross salary per employee, which is 115. Then there's also an employer contribution. Okay, so we must add the employer contribution, because remember, the expense towards the expense that the company incurs is the gross salary that they pay the employee plus the contribution that they make on their behalf. That is all part. So remember, if you, I don't know if you most likely came across an employment contract, then what they tell you, they don't tell you your salary. What do they give you? They give you what they call it, total cost to company. Okay, that's what they tell you. This is your package, which they call total cost to company, something like that. And then one of the line items is your cash salary. But what could be in there? There could be your cash salary. There could be employer pension contribution, like in this case. There could be employer medical contribution. There could be, depending on on your position in a company, it could be shares in the company. So in most cases, gross salary is just one aspect of the total cost to company. So when they recognize an expense, they want to recognize, a company recognizes total cost to company. A company don't only recognize salaries. As far as I've seen, when I was like being in audit as well as being a financial accountant, when in audit, what I've noticed what a company does, what the company do, as well as when I was a financial accountant, each specific line item, they will record separately. So they will have a journal entry just for cash salary. They will have a journal entry for employer contribution relating to pension. They will have a journal entry that captures employer contribution to medical aid. So they have each line item as a separate general ledger account. So that's what happens generally in the real world. So that is why the way you process your journal entry does not matter, because it's not one right way to process a journal entry. Remember, financial reporting, this what we're studying over here, fact 1, fact 2, fact 3, fact 4, got to do with IFRS, International Financial Reporting Standards. Now, International Financial Reporting Standards does not dictate how you record entries. What it does dictate is how you report on something. So the way you record something, no one cares. Ultimately, what they want is that the ultimate reporting needs to be correct. So remember, when we do a journal entry, you can do it however you want to, as long as the ultimate result from a financial reporting point of view is correct. Okay, so just take note of that. So employer contribution, remember the total contribution was 36,000 Rand. Now they said the employer contributes 50%. Okay, so therefore the total package, basically, the total package for this employee, so each employee's total package would be that what am I doing here now? Guys, so just take note of that. Give me one moment quickly. Okay, so take note that they're telling you the number of employees is 10. So monthly gross salary expense in total is 115. Monthly defined contribution plan in total is 36,000 Rand. 50% is employer, 50% is employee. Now, this is not per employee, right? It's total. So just take note of that. So what we want to do is the following. So let's see. Provide the journal entries for the year ended 30th June. So just take note of that. We must provide this for the year ended. Okay, so if that is your monthly salary, so if that is the monthly salary, what they're telling you, it's a monthly gross salary. It is a monthly defined contribution plan, and it is the total amount for all employees for the month. Now, remember, they never asked us the journal entries for the month ended June. They're asking us for the journal entries for the year ended June. So therefore, we multiply by the number of months, which is 12. So therefore, the expense, So total expense, total expense. It is going to be 133 times 12. So I know many people get confused with employee benefits, but it's not so much because it's difficult. It's just that of all the moving parts. So what you need to just make sure, just sit back. So most of you have the benefit of the fact that you are working. So just sit back and think about your own salary, right? Think about your own money that you get. If you look at your pay slip, how your pay slip structured? Your pay slip is basically structured based on all the costs incurred by the employee, less all the deductions that the that gets taken off your salary, and then the net amount which comes into your bank account. So remember, any expense to the employer will be recognized in the income statement, and what gets paid to you would be the net amount. So that's very important. So the expense is the total amount, the total costs incurred by the employer as a result of employing you. So just be aware of that. So in this case, as a result of employing this, as a result of employing this these employees, the company is incurring this 1596, excluding now this the leave pay. Leave pay we show separately. So what gets paid? Remember, all that 1596 comes the credits. So the credits are all the people that get paid. Who are all the parties that get paid? Who are the parties that get paid in this place? It is you, and it is SARS. Okay, so SARS get paid only on the 7th day. So therefore, on 30th June 2018, we can't call it bank because we never paid SARS yet, but we take it to a liability account. We take it to a liability account. So we can say SARS, pay as you earn. Remember, on the balance sheet, we would have a separate SARS account for every SARS payment. So you would have a SARS for income tax. You would have a SARS for pay as you earn. You would have a SARS for VAT. You have to have it separate. The reason being is, in terms of financial reporting, the question would be asked, which account must you have? Can you have one SARS account, or must you have separate SARS accounts? Now, in financial reporting, under IAS 1, there is something, and in certain standards itself, but definitely in IAS 1, there's a concept of, or I think it's IAS 1 or the conceptual framework now, I can't remember, but there's a concept of offset. Okay, so offsetting numbers. So in some of our minds, we may think we are paying SARS, right? So therefore, all the amounts can go to one SARS account. In terms of financial reporting, that is not correct. The reason being is SARS does not allow a company to offset payments relating to different taxes. So you can't offset pay as you earn with income tax or with VAT. VAT only can be offset against VAT for that particular entity. Pay as you earn can only be offset against pay as you earn for that particular entity. Income tax can only be offset against income tax for that particular entity. So as a result of that, because SARS does not allow you to offset against different accounts, you have to have separate SARS accounts for every SARS payment. So you'll have a separate VAT SARS account. You'll have a separate SARS income tax account. You'll have a separate SARS pay as you earn account. Very important. Okay, so this here is going to be working 1. So this is the concept of offset. You can't, in very limited circumstances where you can offset a balance. That is why if you look at some balance sheets, just pick up any company, you look at some balance sheets, they will have a bank and they'll have a bank overdraft. Why don't they just offset? Because most likely the positive bank balance relates to, let's say, their money in FNB, but the overdraft relates to the money in Standard Bank. So because you can't offset money between FNB and Standard Bank, you have to show them separately. So just take note, offset is an important concept for our purposes. Okay. Now for working two, once again, you don't have to do this working two because it's quite simple. You can just plug in the answer, but I'm just going to show you. It's, so it is pay as you earn per employee. They said pay as you earn per employee was 2070. And they are saying that, and we know the number of employees for this division is 10. So what do we get? We get pay as you earn of the sum. Well, not the sum, the product. So that multiplied by that. Okay, so we go over here. And this is working two. So by default, what gets paid? Bang, what gets paid is the difference. Okay, that's just the balancing figure. So that is the, that's dealing with, we'll show you what that's dealing with now. So that journal entry is dealing with the monthly gross expense, the monthly defined contribution, and the 2070. Okay, now what we have to deal with is the leave pay. But let's leave the leave pay for last. Okay, what I want to do, let's deal with the termination benefit. Okay, so remember there are 10 employees that are getting terminated. So there are 10 employees that are getting terminated. Of them that is getting terminated, so what are they getting? So remember, they're getting 30,000 Rand as a result of being terminated. That is why they would, that is why it's considered a termination benefit. If they were not getting terminated, they would not get that 30,000 Rand. And then they say, in the last paragraph over here, Plastics expect that all employees will continue and the company will also contribute 80,000 Rand in total towards employees' defined contribution to the normal monthly contribution. Now remember, what's important, because of the fact that we have issued them, so this is what's important to understand. Here is two parts of the termination. Here's the actual termination, and then there's also the normal earning of their salary. Remember, on 28th June 2018, basically at the end of the financial year, they each got a letter saying they're going to be terminated. In that letter, it says that as a result of being terminated, you're going to get these amounts. By the fact that we have issued the letter, we now have an obligation to pay these employees. So because they got the letter, there is basically a legal obligation to pay these employees. You will see when we come to restructuring, when we deal with provisions, to understand the principle of raising the liability at 30th June 2018 and not raising the liability on 31 August 2018. So remember, the actual payments will most likely happen on 31 August 2018, which is in the new financial year. The question we need to ask, should we raise the termination benefits in the current financial year, 30th June 2018, or should we raise it in the next financial year? It is because they got the letter in the current financial year, 30th June 2018, stating that they are being terminated. And that letter states that because they are being terminated, they're going to be getting a these payments, and remember it's a legal letter, that means there's a legal obligation to, there's a legal obligation for the company to make these payments, and as a result, they have a liability. Very important. So what are we going to raise? So as a result of this letters that was issued in the current financial year at 28 February, at 28 June, at 28 June, what did I just do here now? Because they received these letters at 28 June 2018, which is within the current financial year, the company has a legal obligation to make the payments. As a result, it meets the definition of a liability. So what we're going to do, we're going to raise a liability. So we will just say, whatever you want to call it, restructuring obligation. I don't know what you want to call it. You can call it provision for restructure, for provision for termination, whatever you want to call it. You can see what they call it. So remember, bank is SFP, pay as you earn is a liability. Okay, so SARS is always a liability. Because remember, SARS is not an expense. We owe SARS the money, so it's a liability. So this restructuring obligation, you call it whatever you want to call it. You can call it a termination obligation, whatever you want to call it. All that's important, it needs to be a liability. Okay, so I'm just going to put in, I'm going to make it clear that it is a liability. More correctly, it is a provision. Okay. Okay, so it is a liability. Well, yeah, we can call it a liability because there's no uncertainty. So it is a liability. And remember, what is the amount? The amount is as follows. Each employee, okay, termination costs per employee is 30,000 Rand. Number of employees, okay, so the number of employees is 10, and then contribution, total, which is 80,000. Remember, this 30,000, they're only getting as a result of being terminated. This additional 80,000 is only being contributed to the plan as a result of being terminated. Okay, so so the total termination benefits is the sum of the two. 30,000 Rand per employee plus the 80,000 Rand total. So if I go over here working 3, it is going to be, so working 3, termination benefits. So we're going to say employee costs or employee benefits, termination. Okay, so this is a P&L, and it's going to be whatever that answer was. Okay, so now we are going to deal with the leave pay. Okay, so now we're going to deal with the leave pay. So we have done with everything so far other than the leave. We have done the payment, the salary and the contribution, the normal short-term benefits. Okay, we have dealt with the termination benefits as a result of being retrenched, and then we must still do the other short-term benefit, which is the leave pay. So all I'm going to put in here for now, employee benefits, leave, whatever you want to call it, and then here the leave accrual. So remember, leave accrual is a liability, So we say SFP, and then this is P and L. So let's work out what the amount would be. Okay, so let's work out what the cost would be. So the way you're going to work out a leave accrual, the way we work out the leave accrual is as follows. Working for. So the way we work out the leave accrual, remember, it's very important to know that the leave accrual journal that you process must be the movement from the beginning of the year until the end of the year. So for example, we should be having 30th June 2017 and have 30th June 2018. So you have the balance of 30th June 2017, and we compare it to the balance at 30th June 2018. And the difference is your leave accrual journal. Very important to take note of that. So what we will do, you will work it out as follows. So, so you say balance 30th June 2017, balance 30th June 2018. Okay, so there's no balance on 30th June 2017. So we can assume it is 0. Okay, so I'm just going to assume it is 0. But the way you put a leave accrual journal, because you always work, the way we work out leave accrual is by working out the balance to date, number of days to, so I'll show you how we work out. So I explained this just now. You will understand it better when I do the example. So this movement in leave accrual is the P&L number. Okay, so that's what we recognize every month or every year, depending how we're doing it. So because we're working on an annual basis, that's the leave accrual journal for the year. So the way you work out the balance, remember they never gave us a balance for 30th June. So 30th June 2017. So because they're not giving us information relating to 30th June 2017, all I can assume it is 0. So we have to work out the balance at 30th June 2018. So the way we work it out is basically how you do it in the real world. The real world, they will use Excel spreadsheets generally, right? How they do it in the real world, they will have a list of employees in a column. So let's just say you will have the list of employees, well, maybe an employee number, they'll have name, surname, employee number, whatever other details, but basically a list of employees. Then they would have let's say we're working on an annual basis. So let's say we're working on an annual basis. We will have a, so that list of employees, then we will have at 30th June 2018, you will have the leave days outstanding. Okay, so whatever leave days that each employee has available. So next to each employee, they'll have a list, the number of days available to them at 30th June 2018. Then you sum it up. At the bottom, you'll get the total of the total leave days outstanding. Then, next to that, we will have the daily rate for each employee. So remember, because it's leave days, we want the daily rate for each employee. How you calculate the daily rate is different for different companies. So however the company decides to calculate a daily rate, they'll work out the daily rate, and then they'll say leave days outstanding multiplied by daily rate. So that will give them the total value of leave payable to each employee. Then they sum it up and they'll get the total leave payable. So that's basically what we're going to do. So we're going to have number of leave days. Now remember, in a company, they will have a spreadsheet listing each employee and listing the number of days outstanding at 30th June 2018 for each employee. We just want to get the total. Then we're going to say, basically what we want to get average daily rate. In this case, the daily rate is the same for all employees because they say all the salaries are the same. but in reality, you'll work out a daily rate. In the real world, what they will do, they'll have a daily rate per employee, and then they would multiply that. So each employee, so for example, Bernice, 10 days at 1,000 Rand. So you'll have 10,000 Rand leave payable to you. Valise has 5 days at 1,000 Rand. So it is 5,000 Rand. So they'll add up that total column. Okay, so we don't have that. We will just put in a daily rate multiplied by the number of days. And that will give us the leave balance at 30th June 2018. So leave balance 30th June 2018. So that will what we will get. Now remember, in that same spreadsheet what the company would have, they would have the last leave balance. So if they do it on a yearly basis, they will have the last leave balance, which was 30th June 2017. So now they have calculated leave balance at 30th June 2018. They have the leave balance at 30th June 2017. They take the difference, and whatever that total is will be their leave accrual journal. In the real world, leave accrual is done on a monthly basis. So basically, they will have 30th June 2018, and they will compare it to 31 May 2018. And any difference they will account for in terms of any difference they will account for as your leave journal. So what's very important, the leave journal is not the balance. The leave journal is the movement from one period to the next. Very, very important. And the way we get the movement is by determining the balance. So here you can see I'm calculating the balance at 30th June 2018. I'm then going to compare it to the balance at 30th June 2017, which I know is 0, and I'll get my movement. So what do we know? What do we need? We are going to need the leave days, and we're going to need the average daily rate. So let's work that out. Working 5 and working 6. Okay, so for working 5, the leave days. So they gave us the leave days. So leave days at 30th June 2018. They gave it to us 30 days. Okay, so in normal circumstances, we wouldn't need to calculate it because it is given to us. They gave it to us. So I'm going to say here, given. But why am I still calculating? Remember, they said, so remember, because of this termination. Because of this termination, the termination was given to employees, to these 10 employees at 30th June 2018, at the end of the financial year. They believe that all the employees is going to stay up until 31 August 2018. So at 30th June, they know they are terminating employees. At 30th June, they know they are terminating employees. Okay, so at 30th June, what would happen? They obviously have the 30 days, but for those 10 employees that is going to work up until 31 August, they're going to be working for 2 more months, right? As a result of working for those 2 more months, what's going to happen? They're going to accrue for leave. Okay, so they're going to accrue for leave for those 2 months. Remember, they said they can't take leave in July and in August. So because they can't take leave in July and August, and because we know they're going to be staying in employment up until 31 August, we have an obligation to pay them their leave. So what's going to happen? Leave for termination. Okay, so leave for term, I'm just calling it that. You can call it whatever you want to call it. So remember, each employee gets 20 days per year. So each employee gets 20 days per year. But remember, they're not working for a full year. They're only working July and August. So they're working for 2 out of 12 months. Okay. And that is per employee. So multiplied by 10 employees. So there we can see the number of leave days that they're getting is whatever that is. So the number of leave days, what did I just do here now? So the number of leave days that they are accruing is 33 days. So the total number of days we need to account for is the sum. So there we have leave days is 63. Okay, so just take note of that. So we'd have just used the 30 days, but because of the termination, they got terminated at the end of the year. And as a result of being terminated at the end of the year, they are required to work for 2 more months. And in that 2 more months that they are required to work, they can't take leave. So when they leave at 31 August, we have to pay them what belongs to them in this financial year, as well as what's going to belong to them for those 2 months that they are working. Okay, so just take note of that. So now we need the daily rate. So working 6, we will work out the daily rate. So we know, so the daily rate, we know the total gross salary. Total gross salary, it is 115. So generally, leave is paid on your salary, not on your contribution and so forth. But remember, like I said, each company has their own policy. So they're silent, just use the gross salary amount. Okay, so that is gross salary, total gross salary. So that is going to be, and then number of employees. Number of employees. Let me just see quickly what's happening. So number of employees. I want to just take the annual salary. So the total annual salary, 115 times 12. So we don't include the contribution, okay? Then we're going to basically have a number of employees, which is 10. So annual salary per employee, which is equal to that divided by 10. Now we know each employee, the number of days in the year, number of days per year, they told us is 260. So that will give us the daily rate. So our daily rate is going to be 138 divided by 260. So we're going to round up. So it's 531. So what we're going to do, daily rate equals 531. And so the leave balance is 63 times 531 What am I doing over here? I want to do that. Okay, so 63 times 531. So the movement is closing balance minus opening balance, which is going to be 33,615. My numbers will be slightly different because of rounding. I'm using Excel, okay? So my numbers will be slightly different to the answer. C34. So I'll go over here, equal C34, and equal C34. Okay, so my numbers will be slightly different because I have rounding, okay? But don't let that give you sleepless nights. Okay, so that is basically all the journal entries. What you need to do though is the following. I'm not going to do it. You can do it for yourselves. Is to raise deferred tax. So basically because there is an expense going through, our accounts, we will have deferred tax and so forth. Okay, so what you can do, you must just deal with deferred tax. Okay, so I'm just going to put it here, deferred tax, you must deal with. So that is basically what you need, basically this over here. So this journal entry is leave pay. It's always going to have this issue with leave pay that you're going to have to calculate. This is considered a short-term benefit. Then this over here, which is the salaries, including the contribution to a defined contribution plan, that is a short-term benefit. And then we had a termination benefit. What classified it? What made these termination benefits? That these employees are getting it as a result of being terminated. If they were not going to be terminated, they wouldn't get those amounts. So that is why it is a termination benefit. So what you must take note, we did not record the salaries of, we did not record the salaries of July and August. Why? They still need to work it. So once they work July, once they work August, then we will record those salaries in those months. So remember, just understand that those salaries, they getting it as a result of working as per normal. So that is a short-term benefit in the 2019 financial year. So just take note of that. Okay. That's all that I wanted to cover for tonight. Is there any questions from your guys' side? Bernice, Valise, Rodney, any questions you have on your side? Anything confusing on your side?
No questions and nothing confusing. Thank you.
No questions and nothing confusing.
Fakir, Ashita.
No questions and nothing confusing so far.
Okay, so I'm going to stop here. So that is basically employee benefits. So like I said, the typical question for employee benefits is going to be that part C, or not for employee benefits. What's the typical question? What you will see is they're going to give you that scenario like we had over here in part 2, as well as a scenario in part 1. You're going to do a whole lot of calculations and answer certain stuff. But the real question comes in part C, where they say do the profit or loss. So you must know all the income statement impacts from point number 1, as well as all the income statement impacts from point number 2, and put it in answer part C, which is the note to profit before tax. That's going to be very critical. So make sure when you read a scenario, you can pick up the various items and how you would disclose it in the note of profit before tax. Very important. You can see it's 17 marks, almost half of the paper. Okay, so make sure you can do that. Next week, we will deal with leases. We'll cover leases twice. We're going to do leases in normal class, and then also we're going to do leases in the master class. So we're going to have a master class running next week, and the master class is going to be covering leases. Okay. I'm obviously going to make sure that over over all the lease classes. We cover everything. So when it comes to leases, you must be able to do with lessees, lessors, and sale of leaseback. Okay, we're not going to focus too much on the sale of leaseback. We'll go high level over it. The main focus is going to be on lessees, but you must also know lessors. Okay, so we will make sure we covered everything. So that will be next week. Okay, and then tomorrow for those guys in Fact 2, Fact 4, we will do Fact 2, Fact 4 tomorrow. Okay, so I'll stop here. I'll share the stuff by tomorrow during the day. I'll put it into the Google Drive. Okay, guys, see you. Bye bye.